All right, everybody, welcome back. We are here to talk about capital gains tax today. What is it? How do you calculate it? Let's chat about it real quick. So, first of all, what are capital gains? Capital gains are the profits you make when you sell an asset for more than you paid for it. These gains only become taxable when the asset is sold. So if I buy something and I'm holding it and holding it and holding it, yes, I have a unrealized capital gain in that investment, but I don't have to worry about the taxes for that until I sell that investment. Once I get the money back and I got cash in my hands, no longer have the asset, that is when we are talking about taxes. All right. So this is going to be relevant in stocks and bonds, real estate, collectibles, cryptocurrency. Basically, if you can buy it and it can go up in value or down, and then you can sell it and make a profit on it, capital gains can be relevant. Got a little example over there to make it nice and clear. You buy a stock at $100, you sell it for $250, your capital gain is $150. $250 what you sold it for minus what you paid, $100, your gain $150. That's what you would pay taxes on. Now, there are two different types of capital gains to consider. The first is short-term capital gains. This is going to be for assets that are held for 1 year or less. These are taxed as ordinary income. So what does that mean? That means that you'll see here in a second with long-term capital gains that with capital gains there can be a locked-in special specific tax bracket that you pay. But if you've held the asset for less than 1 year, they just treat it as income. So it's no different than you made the money at your job. So whatever tax bracket you're in and whatever taxes are being withheld from your job, you're going to want to make sure that you are setting that money aside in a likewise percentage from any short-term capital gains you take in these types of investments. If I buy something for $100, sell it for $200, and I've held it for 9 months, I'm going to have $100 of income per share that happened with that I made that year. So if I didn't pay taxes on it when I got my money from that stock sale, I want to make sure I'm setting it aside because at the end of the year, I owe it. I made extra money at my job. Think about it that way. That is short-term capital gains. Now, if I can hold it for longer than a year, now we are talking about long-term capital gains. Those, like I kind of alluded to before, get special tax treatment. Those tax brackets can be at the highest 20%, but usually 15%, and they can even be 0% if your income is low enough to be in that tax bracket. But as you can see, regardless, even if you're at that 15% tax bracket, usually that 15% tax on long-term capital gains is probably going to be better than whatever you would pay at your income tax rate. If you're in the 20% tax bracket for capital gains, it's definitely a benefit to you because the only way you're paying 20% on your capital gains is if your income is very, very high. So if you were paying income taxes on that same kind of gain, it would be significantly higher. So capital gains, if you can hold them for longer than a year, usually you're going to get preferential tax treatment. Now, a little snippet at the bottom. The holding period begins the day after purchase and ends on the day of sale. The preferential rates for long-term gains are designed to encourage long-term investing and economic growth. So there you go. Short-term, less than a year, income tax brackets, no special tax treatment. Long-term capital gains tax rates if you've held it longer than a year. So how do I calculate capital gains? First, I want to determine my cost basis. So I take the price that I paid for my asset. I add any fees that I may have paid at the time of purchase or along the way. I take any improvements that I made, if we're talking about like real estate or something like that, any cost to me that I used to improve it, add that to the cost. And then I'm looking at my cost basis. Now, if I took depreciation, and if you're in real estate, you know what I'm talking about. If I took depreciation, we would need to subtract that out of our cost basis. But if there's no depreciation, it's what I paid plus fees. If it's real estate, if I made any improvements, that all adds to the cost that I paid. and then that would be my cost basis. If I'm realizing depreciation, I'm basically using that cost basis early, not to get too technical. But if you have depreciation, you would want to back that out of your cost basis. It would be bringing your cost basis down, so you paid less. Next, you want to determine the selling price. So take the sale price, how much I sold the item for, and subtract out any selling fees, commissions, the things that I paid. That is my sale price, what I have left at the end of the day. Now to calculate my capital gain, I take that sale price I just created or just calculated, subtract out my cost basis, accounting for any of those improvements and depreciation, and what I'm left with when I take my profits minus my cost plus all that stuff is the capital gain. And then I apply the tax rate. So depending on what my income is, you can look up capital gains tax brackets. I would apply that tax bracket to my capital gain amount. Little example at the bottom to make it crystal clear. If Dale bought 100 shares of ABC stock for $10,000, that's what he paid in total for that 100 shares in 2009, and he sold it in 2024 for $17,500. You take the capital gain of the $17,500, so what his sale price was, minus the $10,000 that he originally put into it. $7,500 would be your capital gain. Let's assume he's in the 15% tax bracket. That would be $1,125 in capital gains tax owed. Now you obviously want to know your tax bracket. It may not be 15%, but this is how you would kind of calculate that more or less. So before I let you go, let's just wrap it up with some key takeaways and next steps. Tax rates depend on holding period and your income level. Accurate records of cost basis and purchase dates are essential to know what your capital gains are. You got to know what you paid to know how much you made. Tax advantage accounts, IRAs, 401ks, they can shelter gains from taxes. So that's not something we touched on here today because that's not the video today. But retirement accounts, because they're tax deferred and tax free in the case of the Roth, they don't worry about capital gains taxes. You don't have to worry about them while they're inside of those accounts. Check out those videos if you're interested in more on that, but that is something definitely to note. Tax loss harvesting, again, not a strategy we're going to cover here today. There'll be another video on that. But if you have losses and you take capital losses throughout your investing tenure, you can use those against capital gains to offset them and reduce your tax burden. If you're trying to do all this fancy stuff, I would definitely consider consulting a tax professional for complex situations. And finally, understanding capital gains helps make you smarter investment decisions and develop more effective tax strategies for long-term wealth building. So, hope you guys learned something here today. Subscribe to the channel if you like this type of content. Smash that like button if you really liked it. And until next time, you guys, that is Capital Gains, and this is Finance AF.